I've been in institutional asset management for almost 30 years. Cannabis is one of the fastest growing industries within America. Every state needs hard assets. They need real estate for growing, they need real estate for the processing, and they need real estate to dispense that into the public. If you enjoy that hobby and getting involved, rolling up your sleeves, then this passive investment may not be for you. We're just over 7 million in total assets, and we're in near-term trajectory to cross 10, but this strategy we could run at 250, maybe even $300 million.
Investors and operators, welcome back to the Invest Clearly podcast. In today's episode, we sit down with Chris Reece, founder of MJ REIT, to discuss how he approaches capital deployment in the cannabis real estate sector. Chris shares how the fund structures its loans, navigates valuation risk, and underwrites properties as if the cannabis tenant disappeared. We cover how MJ REIT communicates with investors, structure its redemption options, and sets expectation around performance, liquidity, and transparency. We also explore the trade-offs of being in a REIT and how investor education shapes the firm capital raising strategy. Let's get into it. The views expressed in this podcast are those of the individual guests and do not reflect the opinions or recommendations of Invest Clearly. This podcast is for informational purposes only and should not be considered investment advice. The appearance of a sponsor or investor on this show does not constitute an endorsement or a warning. Invest Clearly is an objective and neutral platform. Always do your own due diligence before making any investment decisions. All right, Chris, thank you very much for joining me on the Invest Clearly podcast. By means of getting started, I'd love to learn a little bit about you, your background, and MJ REIT.
Yeah, perfect. Pat, first and foremost, thanks for including me and having me on the podcast today. Really excited about our time and going through our story. I figured I would just start very briefly with a quick background. I've been in institutional asset management for almost 30 years, half of those on the public side, and then transitioned to private investments about 14 years ago. And over those last 14 years, I've had the privilege of working at a number of firms, starting a bunch of different strategies. But the idea of getting into passive investing really for me came about when I launched MJ REIT in 2022 with the sole focus of providing investors with a stable asset and above market monthly income. And so we've been focused intently on achieving those two goals. And we'll talk a little bit more about that today as well. But really, it's those two goals that keep us going every day on behalf of our investors.
Yeah, awesome. And I know you guys at MJ REIT, you are not in a unique asset class, but a unique approach to an asset class. Would you tell us a little bit about how you landed in the industry that you're in?
Yeah, it was interesting on the dynamics because I had the opportunity in 2009, 10, and 11 to work at a firm that started the first private BDC, which stands for Business Development Company. We had Blackstone as our sub-manager at the time. But when I looked at why the BDCs were so successful for investors, it was really that they were plugging a hole in an area of the market that needed financing that simply didn't have it. And that was middle banking in America. And so when I started MJ REIT, the reason I got into this particular space is I looked at a number of different industries from infrastructure to precious metals, even crypto, because I wanted to find an industry that had the potential to generate outsized returns, risk adjusted for investors. And I kept coming back to the cannabis real estate area, that cannabis for its part is one of the fastest growing industries within America. And it has limited amount of capital available because you can't go to Wells Fargo or JP Morgan for a mortgage. So you have high growth, i.e. demand, and you have a lack of capital to fund that demand. And then the third characteristic really is that there are limited institutional players in the space today. And so when you put those three characteristics together, I looked at the opportunity to generate a better risk-adjusted return as a perfect match. But unlike lending to an operator or an individual, we're simply financing a piece of commercial real estate. And by doing so, we're focused solely on the hard assets, with real estate being the crown jewel of those assets.
Yeah, great. And do you find that when you're talking with new investors, are you convincing them why cannabis, or is it, more your strategy? You're attracting the right investor. They understand it. It's not like a multifamily guy coming over from, how are those conversations going with new investors?
It's interesting because from an investor standpoint, if you take away all of the, what I'll say, maybe noise is the right word, from being involved in the cannabis area, really what we do is we focus on industrial and retail properties. So it's no different than any other sector. with the exception of we're trafficking in a sector that is cannabis related. And because cannabis is illegal, it has a slight nuance into how we can traffic in that particular area. So a lot of the conversations that we have, I try to first and foremost focus on the asset overall. And the reason I say the asset overall is because what's unique about what we do is we don't provide the borrower any bump in valuation associated with the improvements. So you and I get together, we buy an industrial building for $2 million because we were awarded a license in the state of California to cultivate cannabis. Well, to get that building up to speed on growing cannabis, we may have to put 6 million of improvements. So think about the irrigation, the lighting, the HVACs, high-tech security. So in our mind, that building is worth $8 million because we bought it for 2 and put 6 million in. But from the fund level standpoint, in every transaction we get into, we assume cannabis goes away and I need to find a non-cannabis tenant to replace that cannabis tenant. And I can tell you, a standard industrial tenant doesn't have the need for 14 air conditioners and state-of-the-art security, nor do they, quite frankly, want to pay for it. And so we would come into that situation and maybe value that property at 2 or 2.25 million dollars, and then we would simply underwrite a senior mortgage at about 75% LTV on that lower valuation. And so the conversation for us, while cannabis and the overlay of being within the cannabis space allows us to earn better risk-adjusted returns, the way we value these properties really is as a standard industrial or retail property that, again, assuming that I need to replace that tenant with a non-cannabis tenant, allows us to have that downside risk mitigation that's critical for our investors.
Sure. And are you finding that conversation to be easy to navigate with new investors? Are they understanding, or is it kind of
It's a mixed bag because sometimes people get hung up on the cannabis overlay, and even though they understand our approach to it and the way we mitigate that risk, some investors, quite frankly, have a moral disagreement with it.
Sure.
Right? No different than alcohol or maybe casinos. But the one thing that is undeniable is that unlike alcohol or unlike casinos, there is a medical benefit to cannabis, and it's a proven medical benefit. So there's no going back as more and more states look to legalize. So today, Pat, you have 41 states, DC, and a few U.S. Territories that have at least a medical program in place, and more states coming on all the time. And when that state comes on and has its own program, the interesting aspect with what we do is that you can't cross state lines with cannabis. So every state needs to have its own program to grow, process, and sell. So that creates a barrier to entry. So you can't have Philip Morris buy 500,000 or 1 million acres of land and grow cannabis and transport it across the U.S. at a lower rate. So the logistics and that side simply aren't there yet. And so every state that has that program needs hard assets. They need real estate for the growing, they need real estate for the processing, and they need real estate to dispense that into the public. So it gives us ample opportunity to continue to deploy capital into an ever-growing market that still is fraught with hurdles in obtaining that capital. So to our investors and our prospects that hear about us, sometimes there is the moral disagreement that it's right and they want to stay away from that, which I respect. But where we look at it is we're looking just to be a part of an investor's overall diversified portfolio. And we want to be that fund that allows our investors to maintain that consistency. Most importantly, stay invested through the volatility and then have access to that capital when an investor deems appropriate.
Yeah, that's super, super interesting. And I mean, diversification is the
Number one.
thing right now. I mean, it's interesting even just seeing the advancement of Invest Clearly. I was just talking to somebody recently. The unique asset classes, I know, again, that people bring up and are looking to invest in are straying away from, the core multifamily, the storages. We've had marinas come into play. Someone asked me to put a whiskey barrel fund on the site. We said not yet. So it's really interesting. And I mean, you guys just won the best ever conference pitch slam, and one of their core, like the things they were looking for was the diversification of, so that's awesome.
Which I thought that was interesting. You raised a good point because typically it's value add multifamily that come in and really dominate that conference. But to your point about diversification, even the judges, one of the comments they made was that they have nothing against multifamily, value add multifamily, but they're kind of full of multifamily. So their allocation has kind of filled that part of the bucket. So they're looking at unique areas that will offer additional diversification, because ultimately they're no different than anybody else.
Yeah.
You're looking to build a diversified portfolio. But one of the reasons, and this is why I got into private investments years ago, is when I was investing in the public markets, I thought I built a diversified portfolio until the tech crash of 2000, and then now all of a sudden, the diversification that you thought you had and those low correlations all went to one, and diversification went out the window because in times of global market stress, everything tends to move in tandem.
Sure.
But on the private side, if you have a longer, and this is so important, if you have a longer dated time horizon and you can weather the ups and downs of the markets, and for our portfolio, because we don't price on a daily basis, there's inherently a lower volatility pattern. You can stay invested through the ups and downs of the public stock market because your portfolio has some of that diversification in it, thanks in part to what we do, but in other private assets that don't move as volatile as some of the other assets.
Sure. Very, very interesting. And you are the first REIT I brought on the podcast so far. Is there any reason why you went that model over an alternative?
Yeah, the main point with the REIT is it offers some additional tax advantages for our investors. So because we're taxed as a REIT and the fact that most of our return is distributable income that we pay on a monthly basis, as an investor, you're only paying taxes on 80% of that at the federal level. So your taxable equivalent yield that you would need to find on a comparable basis tends to be higher. So for example, if we paid a 10% annualized distribution, you would need to find an asset with an about 11.3% return that would be taxed to get to the 10% return that we're providing. And for our investors, it's really the idea that we're 1099, and being investor friendly was really important to me in starting this. So not only are we taxed as a REIT, it's a 1099, there's monthly purchases, monthly redemptions, monthly distributions, and monthly valuations. So we want to be as transparent as possible, because I also know that, and there's not knocking a longer term closed end strategy where there's a 5 or 7 year life. But I look at it as, while that might be good, maybe in 2 years or 3 years or 5 years, I need to get to my money. And so for us, it was important to offer a liquidity program that 12 or 18 months down the road, something happens in your life and you may need to get to your capital. And I don't want to be one of those strategies that ties your money up. We want you to come in for as long as it makes sense, create your own maturity schedule. And then when you're ready to move on, we have that liquidity program available.
Yeah, that's great. This episode of the Invest Clearly podcast is brought to you by Scale IR. If you're raising capital, you know the hardest part isn't just generating leads, it's turning those leads into committed investors. That's where Scale IR comes in. Scale IR transforms your investor engagement process with their proven solutions that optimize lead qualification, accelerate investor conversations, and drive higher conversions. From seamless CRM integration and intelligent workflows to expert investor qualification specialists who handle your initial discovery calls, Scale IR gives your team freedom to focus on closing deals. If you're ready to scale your investor relations and capital raising effectiveness, visit scaleir.com to learn more and book your strategy call today. Scale IR. Engage smarter, convert faster. You mentioned transparency in that. Obviously, that's the core of what we're doing here at Invest Clearly. What, number one, does that mean to you at MJ REIT? But what are you doing maybe differently than some other GPs out there as it relates to trust and transparency with new and current investors?
Yeah, and those I think are the two most important aspects, because building trust with somebody and providing that transparency is critically important for them to allocate to you. Think about our own personal lives. Like, are we going to allocate to a strategy that we don't trust the people behind it? No. And so building that trust, which is partly on the transparency, but I think also in addition to the transparency, is it's setting the proper expectations. And I think that's one of the main points that we've done differently than some of the other funds in the marketplace. I will tell you that we are not your 2x or 5x type of return strategy. There's a lot of really good strategies out there, and you should potentially look at those if it fits for your risk budget. But what we're looking to do is just be that steady, consistent strategy where you don't have wild swings in your monthly valuations, and we're consistently exceeding that 10% annualized distribution. So for us, it's that transparency, which we kind of check the box because we provide all of our investors monthly statements. We have monthly webinars. I do a quarterly newsletter, not a quarterly newsletter, a monthly newsletter and a quarterly update on the fund in detail. So all of our investors know exactly what's going on, good and bad, inside of the portfolio. because transparency is critically important, but setting the right expectation is critical for maintaining a good relationship and building that trust with our investors. Because we have a lot of investors that come in, they're interested in the strategy. They're like, wow, is this too good to be true? And they allocate, which our minimum is only 25,000. So they may put in 25 or 50,000 and watch it for 3 months, 6 months, a year, and then come back and say, wow, everything that you gave us in the beginning, you've lived up to. So we're going to
Sure.
reallocate and increase our exposure. And that to me is just the biggest symbol of you've done a good job of building trust and maintaining that solid expectations that you set out in the very beginning. Because if you do stray from those expectations, trust goes out the window immediately.
Yeah. Yeah.
When you start seeing, if I tell you, well, 10% is a great return, but if I tell you 12% or 15% and I deliver 10, then you're not, those expectations are misaligned. And so having the alignment of expectations and exceeding those expectations is really important for the fund and to our investors.
Yeah, I agree. And the setting of the expectations, the alignment of the communication, the transparency, and I think what you had mentioned about your investors reinvesting is a metric I wish more GPs highlighted. I think there's, in terms of an endorsement to another, that is the highest endorsement you could give is here's more of my money because I
Yeah.
trust you and you've done well. But
Well, I think it's interesting, not only from reallocating, upping their current investment, but we also do have a dividend reinvestment program, so you can reinvest those distributions. And I think it's an interesting metric that we have about more than 75% of our current investors taking advantage of that reinvestment because the number one, they don't need the cash flow, but they also see the success that we're having. And when you do reinvest, there is also a financial incentive because you reinvest at 99% of the net asset value. So you do get a 1% benefit if you reinvest. So point is, we have the vast majority of our investors taking advantage of that program.
interesting, very cool. And in terms of your team, I know I've spoken to a few of you guys. Are you primarily engaging with the investors? Do you have a team of IR reps doing that, or what's that structure look like?
So it's interesting. So we'll do both. We'll have the team as well as, I get out, I do a fair amount of podcasts. We do webinars on a monthly basis, as I mentioned. And then we try to hit a number of conferences. And so I'm involved in all of those. But we also, on the IR standpoint, we do have a team that's reaching out individually to continue to not only maintain and build those relationships, because I can't tell you the amount of times that we've had an investor that we spoke with a year ago or 18 months ago that we had a great conversation and they did not invest, and we didn't write them off. They were on a distribution list and we would reach out every once in a while. And then all of a sudden you get an email like, hey, I'm finally ready to come into the portfolio. I've been watching you guys for a year. And so for us, that just is a testament to the strategy overall and the consistency of our performance. And kind of back to the question, we have a mix of individuals that will make that outreach. But most importantly, getting back to the expectations and transparency is we want to provide you the information you need to do the diligence required for any investment, but specifically for ours. Make sure you have all your questions answered, and we really focus on an educational push over a sales push and any interaction.
Yeah, that was going to be my next question. Is how do you balance that, like with what is educational versus what is marketing? Everybody's aiming for that top of the funnel resource, but how do you balance that?
Yeah, and for us, it truly is had some, I guess, missteps or misfortunes working with other firms that didn't necessarily approach it from an educational standpoint. And when you try to sell performance first, it never,
Sure.
performance will come and go, right? But if I sell you performance, and all of a sudden we fall under that expectation, you're most likely going to look to exit the strategy if you can. But if I can position it properly and educate you around the merits of why this investment makes sense for your particular allocation and risk budget, then it's a different conversation. And so we're constantly ensuring that all the material that we put out is first and foremost on the educational component so that you can better understand what we're doing. And after you understand what we're doing, then we get into here's our track record, here's the performance, and here's the process and how we've consistently been able to achieve those expectations. So first and foremost, we lead with education. And quite frankly, given the space that we're in, a lot of our prospects and investors may not have had exposure or really know about the cannabis markets overall. And although we're focused solely on the real estate side of the equation, just the macro education around cannabis, its merits, what's going on, the number of states that are legal, some of the facts that you can't cross state lines, and every one of those states that have a program have a different set of rules and regulations. So every state is different, everything is nuanced. And so for us, it's the education around, why the space overall, and then what we're doing, how the process makes sense. And then finally, kind of proof is in the pudding, which we can provide the track record, and we do on a consistent basis.
Sure. And do you find that since you are in such a unique approach, that your, I don't call them sales cycles, but like decision cycles with investors are longer than like core? Meaning, do you find yourself having more touch, more education, and then you have buy-in, or do you feel people, it's like,
I,
quicker?
for us, it tends to be a little bit longer, mainly because if I come to you with a value add multifamily deal, most likely, especially if you're in the space and the passive income real estate side, you've probably diligenced and you have an idea of what that really means. So if I come to you, number one, in a unique industry that you haven't had any
Yeah.
exposure to, in a strategy it's not a syndication, but it's a fund. And then, so part of the explanation and expectation is we start on the industry overall, and then it's how do we structure the strategy to take advantage of this particular industry? So a lot of it's education on what does it look like to be an investor? How often should you expect communication? What are any of the requirements that need to be considered before allocating to the portfolio? What's the liquidity program look like? So all of those underlying details we take into account when we have conversations, but it tends to be a little bit longer than some of your other more mainstream real estate sectors. I look at it as just, it's our opportunity to educate because again, what I don't want to happen is for our investor to come into the strategy and not fully understand the strategy and then have a sour taste or feel like they didn't get all the information they needed before they make a decision. We don't want that. We want our
Sure.
investors to understand what we're doing and be aligned with how we're running the fund. And if it makes sense, then we certainly welcome an allocation from that investor.
Sure. Has that happened to you guys so far? Maybe someone who didn't fully understand the strategy and the framework?
Yeah, through the life of the fund, and I credit the expectations and clearly getting those set in the beginning. We've only had one investor that has redeemed out of the fund since we launched it in August of 2022. And that investor was actually our first investor. And the reason that he sold was he was buying a shore house down in New Jersey and needed some extra money to put on a down
Yeah.
payment. Outside of that, we haven't had any redemptions in the fund. And I know, like, it will come, but for us, we've not only set expectations, we've exceeded those expectations. So having solid performance, and now we just finished 33 months of performance. So we're only 3 months away from our 3-year track record, and being able to point to that and say, past performance is not a guarantee of future results. Here's the macros, here's the macro environment, here's our process, and here's our track record. And again, kind of going back to that, does it make sense for you? And for the investors that have come in, we've been a valuable part of their overall diversified portfolio.
Yeah, that's great. And so when you think about the next stage for MJ REIT, what does the next level of scale look like for you guys? And then what's the plan to, I guess, scale the expectation setting, scale the
Mhm.
transparency, and everything you guys are doing now as you grow?
Yeah, and so we're always looking to grow the fund and partner with investors that are looking to benefit from what we're offering. With that said, we have an extremely robust pipeline of deals given that scarcity of capital in the marketplace. And deals are episodic in that they might not close for 3 months or 4 months, or they may close in a month because it's all about timing on a number of different parties involved. So we want to have a robust pipeline of deals that we're looking to allocate to. So all in today, we have about $100 million of deals that we're currently going through. But given the scarcity of capital, we can be extremely selective in those deals and fund only the ones that we think are the lower risk and best risk adjusted returns. So as we allocate that capital, what we're always looking to do is continue to diversify the portfolio in the notion that we want to ensure that from an investor standpoint, we're not concentrated in any one specific area, that our investors have access to that transparency and reporting that we mentioned earlier. and just continuing to execute on raising more capital to allocate to those deals. Often will be very clear in the beginning when we have a conversation that this strategy is not a 20 or 15-year strategy, because banks, so number one, cannabis at some point will be legalized. With the current administration, there's no near-term plans of that occurring. So look at it as at least a 5 to 10 year strategy. But at some point, it will be legalized, and or there will be some banking regulation that will allow some of your smaller or even regional banks to participate. And with more capital, that means that instead of me lending on a short-term senior mortgage at 12 to 14 or maybe even 15%, I get to lend at 9% or 8% to be competitive in the market. When that occurs, you should expect, and this is what I say, that our ability to generate returns will be dampened somewhat. But I offset that by saying we also have zero leverage in the fund. So all of the distributions that we're earning are coming out of the interest that we receive off of the senior mortgages that we underwrite. And we use no leverage to juice up those returns. So in the event that instead of lending at 13, we got to lend at 9%, well, we could put 0.5 to 1 leverage in the portfolio and still comfortably be able to meet that 10% targeted return. And that's significantly lower leverage than, say, a Blackstone or BREIT that in some instances may have 3 times leverage in the portfolio. So we're still being conservative and prudent in our use, but ultimately looking to continue to raise capital and deploy in the marketplace that we could take. Today we're just over 7 million in total assets, and we're in near-term trajectory to cross 10. But quite frankly, the strategy we could run at 250, maybe even $300 million. So as we continue to fit into an investor's portfolio, I suspect we'll continue to allocate capital across the board, ultimately generating a better risk-adjusted return for investors. And when that time comes, whether it's 5, 7, 10 years, and maybe you then at that point say, hey, it's been a great ride. And that's when you take advantage of the liquidity program and then move your capital to another area of the market that you think shows more promise.
Sure. Awesome. Awesome. Thank you. All right, Chris, I know we're somewhat nearing towards the end here. I want to ask you the one question I ask everybody on the show. What part of passive investing do you think needs to die?
It's an interesting question. For me, and I don't know if anybody's taking this approach if when you think about that question overall, but for me, it's really passive investing may not be for everyone, which sounds counterintuitive to say that when you're actually looking for passive investors, right, to come into you. But in our initial, what I'll call initial kind of conversation where you're interested in MJ REIT, if you come to me and tell me that you want to have an active role, you enjoy going through the diligence or maybe even finding a tenant or like changing toilets or something like that in the multifamily space, if you enjoy that hobby and getting involved, rolling up your sleeves, then this passive investment may not be for you, at least for the bulk of your portfolio. That doesn't mean that you can't have exposure to passive investments and also add to that some hands-on active investing by buying a couple or maybe even a bunch of different multifamily units. But for us, it's just making sure, getting back to what we started with, that the alignment is 100% solid between what your expectations are and our ability to deliver on those expectations. So that for me is just understanding that what passive investing I think does work for most people. Again, if you're somebody that wants to roll up your sleeves and go out and find tenants, then you need to look on an active investing versus passive.
Yeah, that's great. Too many times people are pushed towards passive and they are more of that active operator. So that's great. So, okay.
Yeah, I was gonna say, because sometimes it's like the soup du jour, right? You think it's the great thing to do, and then you realize I'm kind of bored. I'm getting my monthly check, but like I want more. Like I've
More action.
retired.
Yeah.
I want something to keep me active.
Yeah, 100%. Okay, Chris, before we wrap up, I know we talked about the fund a little bit in the discussion about scaling. Anything else you want people to know about the fund before we wrap up?
Yeah, I think we've covered most of it. Just as kind of a recap, I mean, we obviously are taxed as a REIT, and there's a tax benefit for investors. But primarily, our main focus is really providing that above market monthly distribution to investors, and we've consistently exceeded that in 33 of the past 33 months, so 100% of the time, being 3 months away from our 3-year track record. And we're constantly looking to really fill that void in the marketplace, ultimately to generate better risk adjusted returns for investors. And I would also say that we have a bunch of information available for those that want to reach out on mj-reit.com, which is the website. And we would be honored to have a conversation in more detail about whether or not it makes sense for each individual investor.
Fantastic. And that's great. So mj-reit.com. And if people want to follow you, are you active on social media?
Yeah, social media. So you can follow me personally on LinkedIn, or of course you can follow MJ REIT on LinkedIn as well. So Chris Reece is, you'll see me if you type in my name, it'll come up. I have a bunch of different followers, and then also active on socials as well, both Instagram and Facebook. So it's under MJ REIT.
Awesome. Chris, thank you so much. It was great chatting with you. It's been great getting to know you. You do have a presence on Invest Clearly. For the listeners, feel free to check out the reviews on MJ REIT on Invest Clearly and reach out to Chris if you're interested.
I appreciate it, Pat. Thank you so
Sure.
much.
Thanks, Chris. Thanks for listening to the Invest Clearly podcast. To find verified investor reviews or to claim your GP profile, please visit investclearly.com. If you enjoyed this episode, please remember to like, subscribe, and leave a review because that's how other people find the show. Till next time, invest clearly.